About 2 months ago, I thought I had found one of the best EAs on the market, and just 60 days later, it blew the account. The Sentinel EA was launched by a trusted vendor called Valery Trading, who has developed some of the most profitable EAs over the years, like the Waka Waka. So what went wrong here? Why did we start trading live and almost immediately blow the account? Did the team miss something? Was the vendor's unbelievable track record manipulated? Or was it simply bad luck? Let's take a closer look together and figure it out. So let's start by taking a look at the vendor's track record. And as you can see, it started in 2019 in August, and it's been looking really good since. There hasn't been any major drawdown to speak of until recently, and you can see that in the vendor's account, there is this massive drawdown. Now, the live checkmark is enabled, so we know that this track record is not manipulated. And if we look at our backtest results, and we always backtest before trading any EA, you can see that our backtest matched very closely to what we see in the vendor's account. Now, based on these two facts, the live checkmark and the fact that we know it's a verified track record and our own backtesting, we thought we didn't need to demo test it and we just put it straight onto a live account. It's a reputable vendor, they've got a lot of profitable EAs, the backtest matched their live results, so we decided to trade it live. Over and above that, their track record went back to 2019. So this is a 7-year-old track record. So based on all these facts, we felt it would be safe. Now next, let's take a look at our own track record where we were trading it. And you can see that it started off pretty well. It matched our backtest and it matched the vendor's track record. But what we can see is that shortly after trading it, it went into this long drawdown. And it kind of went down and then it recovered a little bit and then it continued going down until eventually it blew the account. Now, this was only within about 2 months. So what went wrong? Well, there are a few possible scenarios that we could look at. The first is that it was a manipulated track record. However, because again it had the live update checkmark, that means that it actually cannot be manipulated or they cannot make any changes on it to make it look better than what it actually is. Another possible explanation would be that this is just one of many track records. So they had a number of track records and when they launched the EA, this is the one that they shared because this is the one that looked best. Now that's definitely a possibility, but I believe that there is a more likely explanation. But before I explain that, please take a moment to check if you're subscribed to the channel. Our goal is to share everything with you. Our good results, and like in this case, the bad ones too. We're transparent and want to save you the costs of potential losses. And the easiest way to help us continue doing that is to hit the subscribe button. It costs nothing and ensures you stay ahead. Thank you. Now, if we look at the Sentinel AI on the vendor's website, there is a link to the track record that I've already shown you. There's also a 14-day free trial, but more importantly, I want to look at the specs. And what you can see is that since 2019, it's had a growth of 426%. Again, this is verified. The average monthly growth was a little over 2%, and the max drawdown, which we're seeing at the moment, is around 70%. 71 of the 72 months were on profit, and the track record was more than 7 years old. So these are all the factors that led us to simply start trading it live. So they are a very experienced and very reputable vendor, and they have got some of the best EAs on the market, some of the most popular EAs on the market, including the MQL5 marketplace. Now, the second scenario that we'll look at, and this is the one that I believe to be the most likely, is that this is simply an over-optimized strategy. So what that means is that they basically, as they were trading this EA over the 7 years, they made some changes to it and they continuously optimized it, meaning that what they did was while it was trading, they were continuously looking at the settings and looking at how this EA performed in the past and adjusting those settings so that it looks very good on the graph. But in essence, what happens is once you start trading it in a live environment, it fails exactly like we've seen here. But they do have the live update checkmark. And what I believe could have happened here was that this checkmark was only added right at the end, right before they launched the EA. So they were manipulating it and hiding drawdowns until recently when they actually added that live checkmark, because that is something you pay for. That is a feature of my FX book that allows people viewing the track record to know that it is not manipulated. Now, another possible scenario is, of course, the trading conditions. However, in our account, we were trading this with IC Markets. Now, IC Markets are one of the biggest brokers in the world. world. They are very well regulated. They've got some of the best trading conditions in the world, including one of the highest leverages that I've ever seen, 1 to 5,000, depending on where you are in the world, because the regulations of where you are would determine what your max leverage can be. But they've got spread starting from 0 pips, and this broker is particularly well suited to algo trading. They've got a less than 47 millisecond average execution speed, and they are in a very well equipped data center. You can see that 60% of all of their trades are algo trades. So this one is particularly well suited to algo trading. So it's highly unlikely that the trading conditions were responsible for the loss that we saw. And in the vendor's account, they are actually trading with a different broker. So the fact that we're getting similar results in both of these accounts definitely points to the fact that it's not broker related. Now, another possibility is that this EA is suited for bigger accounts. So our account, again, if we go back to the track record, you can see that we had it on a $1,000 account, and the vendor has it on an account that started at 2,000 and has subsequently grown to over 10,000. So although it isn't an equity drawdown, it hasn't closed those trades. So their capital hasn't suffered the loss yet. It is just a drawdown. It could still recover. Anything is possible. It is at about 70% at the moment, and we have seen EAs recover from bigger drawdowns. So we'll have to wait and see. But the point is that this is a much bigger account than the one that we had it on. So it is also possible that this is more suited to a larger account. But again, even with their big account, they are in a big drawdown. With us, it was over 90%. They are currently at 70%, although when we suffered our drawdown, they were at about 65%. And the last possible scenario that I can think of is that we were just simply unlucky. It does happen in trading. An EA can perform exceptionally well for 5 or 6 or 7 years. Something could change very quickly on the market that would cause a sharp move, and the EA just was not developed for moves like that, because the historical data that they had developed it with had never suffered anything like that. So it could really just be a case of being unlucky. But again, I don't believe that is likely. And that is why whenever you are trading, particularly with a grid-based system, it is absolutely crucial that you have some kind of a protection if you want to ensure that you don't suffer these massive drawdowns. Now, again, we set ours up according to the backtest on our smaller accounts. What we've done is we've actually removed the protection, but that is based on our own experience and what we have seen with the EAs that we are trading. It's certainly not a recommendation. I do believe that you should trade with some kind of a protection, but when it comes to grid systems, you just have to be very aware of where you want that to be. Because as I've mentioned, we've seen grid EAs that have dropped 60, 70, 80%, and have actually recovered. So if you had an equity stop or an equity protection at, let's say, 40% or 50%, you might have actually lost half of that account without giving it a chance to recover. So that is really up to you. What are you comfortable with? Where would you be happy in terms of protection? Would you be okay to lose 20% or 30% of your account? Or would you feel more comfortable risking it all and giving the EA the chance to potentially recover from any large drawdowns? So we learned a valuable lesson. Follow the rules. Always. Our rules are simple. Backtest, trade a demo account to test an EA in real conditions, and finally, if it achieves the results we expect, place it onto a live account. We missed an important step, the demo trading. It won't happen again. I hope you found this video useful, and if you have any questions, please let me know. If you want to see 3 EAs that have been trading for more than a year and have paid for themselves in just a few months, check out this video here. As always, thanks for watching, trade safe, and I'll see you soon.